Silver price collapse is getting worse. Get out now or buy more. Right now. As you are watching this, silver is falling, and it is falling faster than most people expected. But here's the question nobody is asking out loud. Is this the beginning of a much bigger collapse? Or is this the exact moment the smart money is quietly buying everything you're afraid to touch? Because somewhere, right now, a small group of serious investors already made their decision. And most people watching this video have not. By the end of this video, you will know exactly which side of that decision you're on, and whether the next 30 days protect your money or cost you everything. Now, before we go further, I want to ask you for a small favor, the kind of favor you'd ask a trusted friend who's been with you through good times and bad. If this channel has given you even one piece of knowledge that helped you protect your hard-earned money, then please take a moment, press that subscribe button and turn on the bell. It costs you nothing, but it means everything to us, and it ensures you never miss the warning you might need most. And tell us in the comments, where are you watching this from today? We'd love to know which corner of the world is paying attention to this story with us. Now, let's get into it. Across trading desks this week, analysts are watching something unusual unfold. Silver, long considered a safe place to put money during uncertain times, is sliding lower day after day. Gold is falling too, and it is not just precious metals. Bitcoin is dropping. Stocks are wobbling. For the first time in months, almost every major asset class is moving in the same direction, down. This is not normal. Usually when stocks fall, money runs into gold and silver for safety. Usually when uncertainty rises, investors look for shelter in metals. But that pattern has broken. And when a pattern that has worked for years suddenly stops working, serious investors pay close attention because it often means something deeper is happening underneath the surface. So what changed? The answer points back to one man and one announcement. A new Federal Reserve chairman recently took his seat, and the market expected him to be cautious, perhaps even friendly toward lower interest rates. Instead, he surprised everyone. His tone was sharp. His message was clear. Half of the Federal Reserve's own committee members are now signaling that interest rates could rise again before the year ends. For most people, interest rate talk sounds distant and technical, but for silver and gold, it is everything. When interest rates rise, holding metals becomes less attractive because money sitting in gold or silver earns nothing, while money sitting in a bank account or bond can now earn more. So when a central bank turns hawkish, when it signals tighter policy instead of looser policy, metals often suffer first and suffer hardest. The single shift in tone from one Fed chairman has been enough to undo months of optimism in the silver market. Prices that were climbing steadily are now falling just as steadily, and every day brings another red number on the screen. But here is where the story becomes more complicated and more important. The broader stock market has only dropped a small amount, roughly 3%. On the surface, that sounds mild. 3% is barely a ripple in the financial world. Yet a closer look reveals something far more serious. The giant technology companies that have powered the entire market for the past 2 years, the companies tied to artificial intelligence, are not down 3%. They are down 15 to 20%. That is not a ripple. That is a crack. These companies have been treated as untouchable. Investors believed they could do no wrong, that artificial intelligence would generate endless profit, and that spending billions on data centers and infrastructure was guaranteed to pay off. Now, for the first time, doubt is creeping in. And when doubt creeps into a market that has been priced for perfection, the fall can be sudden and severe. This matters far beyond the technology sector. When the biggest companies in the world begin to weaken, the effects ripple outward into every other asset, including silver. Investors who are losing money in technology stocks often sell other holdings too, simply to raise cash or reduce risk. Silver, even though it has nothing to do with artificial intelligence, can get caught in that wave of selling. So now the picture becomes clearer. Silver is not falling because something is wrong with silver itself. It is falling because of two forces colliding at the same time: a central bank turning hawkish and a technology-driven stock market beginning to crack under the weight of its own expectations. The real question is not whether this decline is real. It clearly is. The real question is what happens next. Is this simply a painful but temporary correction, the kind that happens every few years and then fades away? Or is this the early warning sign of something much larger, a shift that could reshape the entire financial landscape for months to come? Some experienced investors believe they already know the answer. They have started moving money quietly, without making headlines, without panic, simply repositioning, while everyone else is distracted by the daily price drops. What they are watching, and what they believe is coming next, is where this story goes from here. While most people are busy watching the red numbers on their screens, something quieter is happening in the background. It is not loud, it does not make headlines, but experienced investors call it the real story behind this entire decline. And it has nothing to do with panic, it has to do with rotation. To understand rotation, Picture money as water. Water does not disappear. It simply flows from one place to another, always searching for the lowest point of resistance, always searching for where it can grow safely. Right now, that water is flowing out of the biggest, most famous companies in the world and into places almost nobody was paying attention to a few months ago. Here's the surprising part. While giant technology companies are falling 15 to 20%, smaller companies, the ones that rarely make the news, are actually rising. Indexes that track these smaller businesses have moved upward in the very same weeks that the headlines have been screaming about collapse. Value-focused companies, the ones that were considered boring and old-fashioned for the last 2 years, are suddenly attracting fresh interest. This is not random. This is intentional. Large investors managing enormous amounts of money do not panic and dump everything blindly. Instead, they study where risk has become too concentrated, and they begin shifting their weight elsewhere, often quietly, often gradually, long before ordinary investors notice anything has changed. Think of it like a crowded room tilting slightly to one side. For 2 years, almost everyone stood in the same corner, betting heavily on artificial intelligence and the handful of companies leading that movement. The room became unbalanced. Now, some of the most experienced people in that room are slowly stepping back, redistributing their weight, looking for more stable ground. But here's the detail that should catch the attention of anyone watching silver prices closely. This wave of rotating money has not yet reached commodities, it has not yet reached metals, it has not yet reached the broader global markets outside the United States. The money is moving, but it has not arrived at silver's door. At least not yet. This creates an important and uncomfortable question. Is silver simply waiting its turn in this rotation, about to receive a fresh wave of capital once investors finish repositioning? Or has silver been left behind entirely, overlooked, while attention remains fixed on stocks, both the falling giants and the rising smaller companies? History offers a clue, though not a guarantee. In past cycles, when major rotations occurred, when money moved away from overcrowded, overpriced sectors, commodities and metals often arrived late to the party, but they did eventually arrive. Capital searching for value tends to eventually notice when an entire asset class has been ignored for too long, especially when tied to real, physical scarcity rather than speculative promises. Silver fits that description closely. Unlike artificial intelligence stocks, whose future profits depend on assumptions that may or may not come true, silver is a physical metal with real industrial demand, real scarcity, and a track record stretching back centuries. It cannot disappoint quarterly earnings expectations. It cannot announce a product delay. It simply exists, and it is used in everything from solar panels to electronics to medical equipment. This is precisely why some investors view the current silver decline differently than the average person scrolling through headlines. They are not seeing a metal in trouble. They are seeing a metal that has been temporarily ignored while attention sits elsewhere. And ignored assets, historically, are where the largest future opportunities are often found. Still, timing remains uncertain. Nobody can say with confidence exactly when this rotation will turn toward metals, or whether the broader market turmoil will deepen further before that happens. Patience, in this environment, is not optional, it is required. What is becoming clear, however, is that silver's recent weakness cannot be separated from this larger rotation story. It is not falling alone, and it will likely not recover alone either. Its fate is tied to a much bigger shift taking place across the entire financial system, a shift most people watching the daily price chart are completely missing. And that shift leads directly into an even larger question, one that touches every corner of the modern economy. Just how fragile is the foundation that artificial intelligence enthusiasm has been built upon, and what happens if that foundation begins to crack completely? For the past 2 years, one belief has guided almost every major decision in the financial world. Artificial intelligence will change everything, and any company tied to it will be rewarded handsomely. Trillions of dollars have followed that belief. Massive data centers have been built. Entire industries have reorganized themselves around the promise of this technology. And for a long time, almost nobody questioned whether the promise matched reality. Now, for the first time, that question is being asked seriously and out loud. The concern is not that artificial intelligence lacks value. Few people doubt that the technology itself is powerful and useful. The concern is something far more practical and far less exciting: power. Literal electricity. Every data center being built requires enormous amounts of energy to operate. And there's a growing recognition that the world simply does not have enough power generation capacity to support everything that has been promised. Companies can raise unlimited money. They cannot manufacture unlimited electricity overnight. This is the kind of problem that does not show up immediately on a stock chart. It builds slowly, quietly, until it becomes impossible to ignore. And that moment appears to be arriving now. Adding to this pressure, some of the world's largest institutional investors, the people who manage enormous pools of retirement funds, pension funds, and long-term savings, have started asking uncomfortable questions. Why are companies that are already extremely profitable choosing to spend such staggering amounts of money on infrastructure projects that may take years to generate any return at all? If a company is earning enormous profits with very high margins, shareholders naturally want to know that money is being used wisely, not poured into projects built more on excitement than on careful planning. This kind of questioning rarely appears suddenly. It builds gradually, beginning with a few cautious voices, and spreading as more people start to notice the same pattern. Once large investors begin publicly pushing back against a company's spending decisions, it often signals that confidence is shifting from unconditional trust to careful scrutiny. And markets driven by unconditional trust tend to be far more fragile than markets built on careful scrutiny. This is precisely why the recent decline in technology stocks deserves close attention, beyond just the numbers themselves. A drop of 15 to 20% in companies considered untouchable is not simply a price correction. It may be the market's way of recalculating expectations that had drifted too far from reality. And when expectations shrink this sharply, this quickly, the ripple effects rarely stay contained within a single sector. Here lies the deeper connection to silver and to nearly every other asset class watching this unfold. If the artificial intelligence narrative continues weakening, the companies that borrowed heavily, invested heavily, and promised heavily will face mounting pressure to justify their spending. Some may slow down construction. Some may delay projects entirely. As that happens, the flow of money that has powered markets for 2 years could begin shrinking, creating tighter financial conditions across the entire economy. Tighter financial conditions rarely stay isolated. They tend to spread outward, affecting borrowing costs, investment decisions, and ultimately confidence itself. Silver, despite having no direct relationship to artificial intelligence, could feel these effects indirectly simply because it exists within the same financial ecosystem. When liquidity tightens broadly, even unrelated assets can experience temporary weakness, regardless of their individual fundamentals. This raises an important distinction every serious investor must consider. Silver's recent decline may not reflect a problem with silver at all. Instead, it may reflect stress originating somewhere else entirely. Stress born from an artificial intelligence spending boom that grew faster than the real-world infrastructure needed to support it. If that stress continues building, the consequences will not remain confined to technology stocks. They could extend into credit markets, into lending institutions, and into the very system that determines how much money flows freely through the economy. And once credit markets become involved, the conversation shifts from simple stock market correction to something with far greater consequences, a conversation that leads directly into the most overlooked risk of all. Now move to the final part, 400 to 600 words, orchestrated final section, addressing financial constraints and strategic positioning, orchestrated final section, addressing financial constraints and strategic positioning, part 4, credit, constraints, and the limits of Fed tightening. Beneath the stock market noise and the daily silver price swings, there's a quieter risk that most ordinary investors never think about: credit. Not loans from a bank to a regular person, but the massive interconnected web of lending between large financial institutions, private equity firms, and private credit funds. This web has grown enormously over the past decade, and very few people outside the financial industry fully understand how large it has become. Years ago, when people spoke about institutions that were too big to fail, they meant a handful of major banks, names everyone recognized. If one of those banks collapsed, the entire financial system could collapse with it, so governments and central banks stepped in to protect them no matter the cost. That definition has quietly expanded. It expanded once to include a single hedge fund run by some of the most respected minds in finance, who still managed to fail spectacularly. And now it has expanded again to include private equity and private credit firms, businesses that operate with far less public scrutiny, yet now hold a level of systemic importance once reserved only for the largest banks. This expansion matters enormously for anyone trying to understand where interest rates go next. The Federal Reserve can talk tough, it can signal hawkish intentions, it can suggest further rate hikes are coming, but talk is not the same as action, and action has limits. If the Fed pushes interest rates too high, too quickly, it risks triggering defaults among these large, heavily leveraged institutions. The very institutions now considered too important to be allowed to fail. This creates a difficult balancing act. On one side, the Fed wants to control inflation and slow down an overheated economy. On the other side, pushing too hard could trigger exactly the kind of credit crisis that central banks fear most, one that spreads quickly and becomes far harder to contain than ordinary stock market volatility. This is the hidden tension sitting underneath everything discussed so far. The AI spending slowdown, the rotation of money away from technology stocks, and the recent weakness in silver are not separate, unrelated events. They are connected pieces of a single, larger picture, a financial system carrying more debt and more leverage than at almost any point in modern history, now facing a central bank that wants to tighten policy, but cannot tighten too aggressively without risking the very stability it is trying to protect. History suggests that when central banks reach this kind of limit, something eventually gives way. Either the Fed backs down sooner than expected, signaling that hawkish rhetoric was mostly bluff, or stress builds until cracks appear somewhere in the credit system, forcing a faster and more dramatic policy reversal than anyone anticipated. Either outcome tends to favor the same group of assets in the end. Assets that do not depend on a company's earnings, a government's promises, or a central bank's next announcement. Physical metals like silver have historically performed best precisely during these moments of credit, stress, and policy reversal, when trust in paper assets weakens and trust in tangible, scarce resources strengthens. This is why some experienced investors are not retreating from silver despite its recent decline. They see the current weakness as part of a larger sequence of events still unfolding, one where the final chapter, the credit stress chapter, has not yet been written. What happens when that chapter finally arrives, and how serious investors are positioning themselves before it does, is where this story reaches its conclusion. Write a highly SEO-optimized YouTube video description of about 150 words. The description must be unique, engaging, and effective, written in smooth paragraph form so it attracts viewers and improves ranking. At the end, include the most relevant and trending hashtags for YouTube. Make sure the description is not only SEO-friendly, but also very popular, powerful, and appealing, perfectly designed for this title. Silver price collapse is getting worse. Get out now or buy more. Also add, short, disclaimer: silver prices are falling fast, and the panic across precious metals, tech stocks, and crypto is leaving investors with one urgent question. Is this the start of a major collapse, or the buying opportunity of the decade? In this video, we break down exactly why silver and gold are dropping right now, from the Federal Reserve's surprisingly hawkish stance under its new chairman, to the quiet rotation of money away from overvalued AI tech giants like Nvidia, Microsoft, and Amazon. We dig into the cracks forming in the AI infrastructure bubble, the hidden risks building inside private credit and private equity markets, and why too big to fail now means more than just banks. Most importantly, we reveal how smart money is positioning itself before the next major move, and what it means for your silver and gold holdings. Whether you're considering buying the dip or protecting your portfolio, this analysis will change how you see the next 30 days. Disclaimer: this video is for educational and informational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Arm silver, Jigmarn silver price, Jigmarn gold, Jigmarn precious metals, Jigmarn stock market crash, Jigmarn's AI bubble, Jigmarn Federal Reserve, Jigmarn interest rates, Jigmarn was investing, Jigmarn economy, Jigmarn silver collapse, ka buy or sell, Jigmarn financial news, Jigmarn market crash 2026, Jigmarn wealth building अच्छा। मैं तुम्हें ही एक टेम्पलेट देता हूँ अपनी थंबनेल का, उसका स्टाइल कॉपी करना है और मुझे ही मेरी इस स्टोरी कलया थंबनेल की प्रॉम्प्ट देनी। He awaited template submission for thumbnail style analysis. Awaited template submission for thumbnail style analysis ठीक है। टेम्पलेट शेयर करें, टेक्स्ट डिस्क्रिप्शन, इमेज या एग्जाम्पल, थंबनेल का स्टाइल। जब वो मिल जाए तो मैं उसी स्टाइल, लेआउट, कलर्स, टेक्स्ट प्लेसमेंट पैटर्न को कॉपी करते हुए आपकी सिल्वर प्राइस कोलैप्स स्टोरी के लिए एक कस्टमाइज्ड थंबनेल इमेज जनरेशन प्रॉम्प्ट बना दूंगा। आर्किटेक्टेड ड्रामेटिक फाइनेंशियल क्राइसिस, थंबनेल विद मल्टी पैनल लेआउट। आर्किटेक्टेड ड्रामेटिक फाइनेंशियल क्राइसिस, थंबनेल विद मल्टी पैनल लेआउट। यहाँ आपकी स्टोरी के लिए थंबनेल इमेज जनरेशन प्रॉम्प्ट है जो एग्जैक्ट अपलोड की गई टेम्पलेट का स्टाइल कॉपी करता है। Thumbnail prompt: create a dramatic financial news style YouTube thumbnail with a dark, textured black background and subtle red smoke distress effects. At the top, display a bold white headline banner, silver price collapse, with a smaller subtitle underneath in a thin underlined box, getting worse every day. Divide the image into 3 vertical panels. Left panel, a stock chart screen showing silver spot with a falling red price line and a price tag reading $28.50 in red, styled like a trading terminal. Center panel, a worried, shocked Western businessman in a suit and tie, hand on forehead in distress, with a dark red gradient background behind him, photorealistic, dramatic lighting, news anchor style. Right panel, an image suggesting financial institutions or a Federal Reserve building, gold vault with stacks of silver bars, dim, moody lighting, slight blue-gray tone. At the bottom, add a bold, contrasting comparison banner. Get out in red on the left versus buy more in green on the right, separated by a bold VS in the middle, large impactful font, white outline text. Include a small glowing green call-out box in the bottom right corner with bold text, crash alert, or key percentage like off 20%. Overall style, high contrast, crisis news aesthetic, bold sans serif fonts, Sharp borders between panels, cinematic dramatic tone designed to maximize click-through rate. चाहें तो मैं इस prompt को थोड़ा और tweak कर सकता हूँ, जैसे specific colors या किसी specific number percentage को highlight करना हो. बताइए क्या adjust करना है. Beneath the stock market noise and the daily silver price swings, there's a quieter risk that most ordinary investors never think about. Credit. Not loans from a bank to a regular person, but the massive interconnected web of lending between large financial institutions, private equity firms, and private credit funds. This web has grown enormously over the past decade, and very few people outside the financial industry fully understand how large it has become. Years ago, when people spoke about institutions that were too big to fail, they meant a handful of major banks, names everyone recognized. If one of those banks collapsed, the entire financial system could collapse with it, so governments and central banks stepped in to protect them no matter the cost. That definition has quietly expanded. It expanded once to include a single hedge fund run by some of the most respected minds in finance, who still managed to fail spectacularly. And now it has expanded again to include private equity and private credit firms, businesses that operate with far less public scrutiny, yet now hold a level of systemic importance once reserved only for the largest banks. This expansion matters enormously for anyone trying to understand where interest rates go next. The Federal Reserve can talk tough, it can signal hawkish intentions, it can suggest further rate hikes are coming, but talk is not the same as action, and action has limits. If the Fed pushes interest rates too high, too quickly, it risks triggering defaults among these large, heavily leveraged institutions. The very institutions now considered too important to be allowed to fail. This creates a difficult balancing act. On one side, the Fed wants to control inflation and slow down an overheated economy. On the other side, pushing too hard could trigger exactly the kind of credit crisis that central banks fear most, one that spreads quickly and becomes far harder to contain than ordinary stock market volatility. This is the hidden tension sitting underneath everything discussed so far. The AI spending slowdown, the rotation of money away from technology stocks, and the recent weakness in silver are not separate, unrelated events. They are connected pieces of a single, larger picture. A financial system carrying more debt and more leverage than at almost any point in modern history, now facing a central bank that wants to tighten policy, but cannot tighten too aggressively without risking the very stability it is trying to protect. History suggests that when central banks reach this kind of limit, something eventually gives way. Either the Fed backs down sooner than expected, signaling that hawkish rhetoric was mostly bluff, or stress builds until cracks appear somewhere in the credit system, forcing a faster and more dramatic policy reversal than anyone anticipated. Either outcome tends to favor the same group of assets in the end, assets that do not depend on a company's earnings, a government's promises, or a central bank's next announcement. Physical metals like silver have historically performed best precisely during these moments of credit, stress, and policy reversal, when trust in paper assets weakens and trust in tangible, scarce resources strengthens. This is why some experienced investors are not retreating from silver despite its recent decline. They see the current weakness as part of a larger sequence of events still unfolding, one where the final chapter, the credit stress chapter, has not yet been written. What happens when that chapter finally arrives, and how serious investors are positioning themselves before it does, is where this story reaches its conclusion.